Fixed Income All Federal Tax 2024 Canada Bond Offering by Dwayne Gray, July 8, 2024. Bond Present Value PV. Payment of $250 or $2,500 semi-annually over 20 years, which equals 40 payments. The discount rate of return is 7.2%. The interest is compounded quarterly every quarter. The bond costs 11,985.02 or 119,580.20 respectively. If you deduct 20.5% marginal tax rate, your interest per share will be $9,506.66 or $95,666.26 on your investment on a bond par of 10,000 and 100,000 after tax. The real rate of return is 4.13%. Payment of $250 and $2,500 700 over 20 years equals 40 payments. Interest is compounded quarterly. The bond costs $14,777.77 and $1,147,777.77 respectively. If you deduct 20.5% marginal tax rate, your person would be $11,551 and $117,483.83 on an initial bond of par of $10,000 or $100,000 after tax. Bond present value, number of years, payments, payments per year, compounding per year, discount rate, present value before and after tax, then the inflation and nominal rate, discount rate, present value, present value before tax, after tax. I gauge this bond on a bond value of approximately $55,876 to $111,733, $733 federal tax rate, 20.5% tax rate. May need also provincial Canada rates for taxation. Why would an investor buy a bond at a premium if it guarantees a capital loss? If you're new to investing in bonds, you may wonder why anyone would buy a bond at a premium that would produce a capital loss if held to maturity. In fact, there are more to bonds than purchase price. Although capital loss is guaranteed, you should not overlook dream coupon payments and their reinvestment potential. For example, consider a bond that costs $1.03, $103 and matures in 4 years. The bond pays a 7% coupon rate. If you pay $103 and hold the bond to maturity, you'll end up with $3 capital loss. However, over the course of the 4 years, you'll receive the following payments from the issuer: $3.50, $3.50, $3.50, $3.50, $3.50, $3.50, $3.50, $3.50 plus 100 equals 128 also. Each time you receive a regular coupon payment of $3.50, you have the opportunity to invest that money in the market and earn a return on it. So you would have paid $103 for the bond, will reach $120 till maturity. So you would profit $128 plus $103 equals $25 off the par value of $100. Bond principal and coupons. This is a very lucrative bond if you can find similar security in the market. I probably suggest that the bond offering interest income probably be in junk status, as the same 2,500 coupon paying 70 ounces off $100,000 investing over 20 years, adding to $100,000 itself on the bond with that coupon, which is 100% return alongside the principal recover at the end of the term, which is also $100,000 also. If the junk bond is a bond, if it is a junk bond, the bond is not investment grade, and if it's in then Moody's rating, which is that there is a good chance of default, losing all of your investment. Remember, bonds carry risk, but the default risk on junk bonds may not pay. But alternative investments that deal with high yield, this little insurance that parents may be made as it looks essentially for these type of assets to support in restructuring. This is a covenant. This may be a worthwhile endeavor. A high yielding bond is a type of credit strategy invests in below investment grade debit securities, otherwise known as junk bonds. These bonds are typically rated BB or lower on Standard & Poor or BA or lower on Moody's. Managers of this strategy look to earn returns through investment income and capital appreciation by the way of credit upgrade or takeover.